In this week's video, we'll examine the question, a false rally or sustainable reversal in stocks. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a daily chart of the S&P 500 index as of 11:18 a.m. on Friday, when the S&P 500 was up almost 32 points. This looks very, very noisy. It's easy to understand if we walk through each piece in isolation. We have several forms of possible resistance. Possible because we don't know what will happen. It's possible that it acts as resistance. It's possible that it breaks through. Form number one, 200-day moving average, comes in at 1906. On Friday, we were below it at 1895, midday roughly. Here, resistance, 1897. Here, resistance, 1902. The same area acted as support here at roughly 1905. From Thursday's close to get to this line here, the S&P 500 would need to gain 42 points, which is possible relative to what the DAX did on Friday. If it does and we clear these levels, we still have a clear downtrend in the form of this pink channel here. So this is your second set of resistance. We could rally all the way to 1940 before the close on Friday, and we would still be in a downtrend and still within what was previously a reasonably defined channel. If that gives way, then support here, the blue line, support here, the blue line, what once was support may now act as resistance right around 1965-ish. Is it possible that the S&P 500 blows through all of these levels and we rally? Absolutely, positively, yes, it's possible. But we need to see evidence of improvement rather than anticipate it. We may see it, and if we do see it, we're happy to take action. S&P 500 daily, we're updating the Fibonacci retracements based upon this high and this low here. What this tells us is a normal counter trend rally can occur. It's normal to rally back to this level of 1897, 1920, or 1943. Once you clear 1943, the probability of it being a counter trend rally starts to diminish, and the odds of it being a trend change start to increase. So we can remain somewhat skeptical as long as the S&P 500 remains below these levels. No predictions here, they're simply guideposts. We have a lot to cover, so we'll be moving quickly. These are weekly charts used by the CCM market model. We use the moving averages. We'll explain this concept once and then quickly show it on numerous charts. It applies in numerous cases. This is price. We use these moving averages to discern between volatility to ignore, volatility to ignore, volatility to ignore within the context of an ongoing downtrend. We try to differentiate between that and volatility to respect, where the odds of a trend change are now in place. This is a much more favorable look than this. Are we saying 2014 is like this or this? No, we're not. We're using extreme reference points to help paint a picture of what the present day looks like. As of 11:31 on Friday, October 17th, during the trading day, the S&P 500 was still down for the week, 12 points, and we still had what we refer to as a full-bore bearish look. One of the reasons why we have not bought the rally during Friday's session. We need to see this to start to morph into a look more like this, so the market model can begin checking bullish rather than bearish boxes. We've covered this chart on Twitter. I don't want to spend a lot of time here. This is the VIX as of Friday at 10:54 a.m. when the S&P 500 was up 27 points. Net bottom line, this is a fear breakout. This is a trend channel. This is a breakout here. Last week we closed above this green line. As of Friday at 10:54, when the S&P was up 27 points, the VIX was weak, but it was holding the fear breakout. If you're a stock market bull, you'd prefer to see the VIX get in this area. If you're a bear, you want it to stay where it is now. It's still in this area. If you want to pause your video player and look at any of the charts in more detail, you can click on this button in the lower left-hand corner. Going back to our full-bore bullish and bearish look concepts, this is 11:33 a.m. during the big rally in Friday's session. If you came into the week short, you were still beating being long by over 1%. And this chart has work to do. This is what we call a full-bore bearish look in favor of being short relative to being long. Looking at more observable evidence in our common moving averages that we use, the S&P 500 as of September 19th, as of October 2nd, as of Thursday's close, October 16th, and as of Friday morning, October 17th at 11:45 a.m. when the S&P 500 was up 34 points. You can see during Friday's rally, price is below all of the moving averages. The fastest moving average is on the bottom up here, not what you want. This is what a bullish look looks like. The slopes of all of them are down and prices below them. That's not what a bullish look looks like. This is bullish, this is bearish, this is flat, and this is indecisive. This is telling us that the trend has work to do from an observable evidence perspective. The vast majority of the answers to the questions, actually all of them, because this is flat, are no here. If you want to learn more about this, go to our website, click on the FAQ link in the left margin, go to question 8, and watch these videos where we describe how we use observable evidence rather than forecasting or predicting to manage risk from a probabilistic perspective. Back to our normal concepts, stocks versus bonds, full-bore bearish look 2008, full-bore bullish look 2009, extreme cases. The present day during the big rally on Friday, October 17th at 11:34 a.m. still has a full-bore bearish look. We need this to morph into something like this. Is there anything to be positive about? Well, sure there is. The NASDAQ, as of 11:35 a.m. on Friday, was green for the week, and clients know that we still have some positions in tech stocks, so there's some good news. This chart has work to do. It may do it. It may morph into something like this, but we don't anticipate it. We need to see it. Same concepts here, extreme case, present day looks more like this. We're not saying it is 1987. We're just using these as reference points. This chart, like many of the others, as of 12/28 during Friday's big rally, has work to do. Despite the big rally on Friday, the Dow was still down 141 points for the week. We wrote an article this week, the most important chart on Wall Street, that you can find on our blog, Short Takes, via our home page. Just wanted to update you. As of 11:22 on Friday during the big rally, we were at 10,291 at 11:22 a.m. on October 17th. If you're a bull, you'd like to see the NYSE composite close above this level on Friday. Small caps weekly, 11:09 a.m. on Friday, October 17th. Last week in the video we showed that we broke support. The big rally this week so far can be classified as a counter trend rally, and we have not cleared these resistance levels. If you're a bull, your odds of good things happening increase if you can move into this area here. We'll keep an open mind, but like the other charts, this weekly chart has some work to do. This is the German DAX index weekly. Why do we look at the DAX? It has a very, very high correlation to the S&P 500. Point of the exercise here, this is a bearish trend change. We have all three of our bearish steps. Admittedly, this is as of the close on Thursday, October 16th. What did Friday's rally do? Not much, at least yet. Again, as of the close on the 16th. Here, we did gain 3% on Friday, meaning all we did was we came back to this point here. This is a bearish break. We have not moved in this direction. We could move 14% in this direction from Thursday's close, and we would still have a downtrend. What this tells us is all markets, they could reverse, but they have a lot of work to do before the odds from a risk-reward perspective start to shift into our favor instead of where they are now, which is against investment success, looking out several weeks or several months. We've covered this on Twitter, but these are counter-trend rallies within the context of a downtrend. If you want to find more of these charts, you can pause your video player and Google this text. Going back to this tweet, emotions are not a good way to make decisions. Since the fear of missing out is a strong human emotion, we have to have discipline, follow our rules and follow our system. The math, the evidence, the rules, and the model will tell us when the odds are improving from a probabilistic perspective so we can scale back in. When will that happen? We have no idea. We don't need to know. We just need to pay attention and remain aligned with the market's current profile, which was the case as of Friday. Going back to our question, it's a little too early really to answer it, but right now wouldn't be classified as a false rally, but it would be classified clearly as a counter-trend rally within the context of an ongoing downtrend until proven otherwise. If the evidence changes, then we're willing to change with it. We don't anticipate that it will change. We have to wait. So for us to move into a more sustainable reversal situation, meaning from down to up, we need to see the evidence that we've just reviewed improve. The more levels that are taken out and the more charts that improve, the higher the probability that we get a sustainable reversal situation. We're not there yet. Right now we're in counter-trend rally. That's how this has to be classified until proven otherwise. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.